Hi, everybody. This is Peter Schiff. It is Friday, October 3rd, 2014. This morning was the release of the highly anticipated September non-farm payroll number, coming in better than expectations. The pundits, the markets are all euphoric in response to the number. But I think, as always is the case, the real story is very different from the one that you read in the headlines. And I think the traders and the markets are ignoring what's really going on, not only beneath the surface of this superficially strong jobs numbers, but they're ignoring all of the other economic data that came out during the week. And there was a lot of data that came out this week, almost all of it bad. Yet the markets are simply focusing on this one piece of good news and ignoring the more numerous pieces of bad news. And by the way, in this video blog, I'm just going to focus on the jobs report. But if you want to get a more detailed analysis of all the economic data that came out this week, and maybe more importantly, the way the markets reacted to it, the currency markets, the precious metals markets, the stock market, make sure and watch my podcast, or listen to rather my podcast. I have been posting my podcasts every Monday, so most likely the fifth one will also come out on Monday. You can listen to the podcast at schiffradio.com. You can download it off of iTunes. You can also listen to it on this YouTube channel. Those of you who subscribe to my video blog from the Euro Pacific Capital website, make sure you also subscribe directly to my YouTube channel, because there are a lot of videos that I post where we don't send you out a message as being a subscriber to the video blog, including the postings of my podcast. So again, if you just go directly to the YouTube channel, you'll be notified when we put a new podcast. But again, I'm anticipating it will be up on Monday. But let's get back to the jobs numbers that came out earlier this morning. The number that we got for non-farm payrolls for September, 248,000 number of jobs created. The consensus forecast was for, I think, 215,000. So we beat it, by a bit of a margin. I mean, not a huge beat. The previous month, which was originally reported at just 142,000, August, they revised this up to 180,000. Now, most people were looking for the August number to be upwardly revised above 200,000. So that upward revision was actually less than what a lot of people were anticipating. If you average the last 2 months, if you take August and September and you average them, you get 214,000 average, still above 200,000, but nothing spectacular. In fact, if you look at the 6 months prior, from February through July, February was the first month that we got above 200,000. And every month through August, save March, was above 200,000. And March was barely below at 192. But if you take the average of those 6 months, you get 238,000 jobs. So the last 2 months are actually below that pace. So to me, it doesn't seem like the trend is accelerating. I still think the job creation trend is decelerating, but it actually gets worse when you look beneath these numbers, which we're going to do. But first, let me talk about the unemployment rate. That maybe was the real shocker, which was supposed to come in unchanged at 6.1, which is where it was in August. Instead, it dropped down to 5.9. This is the first time I think we've been below 6% since Obama's been president. So, 5.9. And conveniently, it might help the Democrats in these midterm elections in November, because I think this is the last official unemployment release that we're going to get before voters have to go to the polls and cast their votes. I'm not saying that there's any monkey business going on behind the scenes here, but it's just curious to point this out. Now, the markets, of course, are looking at the drop in the unemployment rate, and they're looking at the increase in payrolls as confirmation of the recovery, the validity, the strength of the recovery, and that Janet Yellen and the Federal Reserve are going to not only end QE, but raise interest rates. In fact, maybe even raise them earlier in 2015 than people believe, because the unemployment rate is dropping more quickly than the Fed believed. And it's those beliefs, I think, that are driving the dollar higher, gold lower, that are supporting the stock market. Again, all of that I will get into in more detail in my video blog. But you have to understand why the unemployment rate is coming down. You have to also understand why the jobs are being created and where these jobs are, what kind of jobs these are. Nobody's really asking these questions, because if they were, they would discover the answers and they wouldn't like them and they wouldn't be as happy about the report. First of all, some of the other numbers that we got. Average hourly earnings were unchanged for the month. Now, the expectation was that earnings would rise 0.2%. That's not even a big increase, but we didn't even match that. We got flat. And the labor force participation rate, which was at a record low of 62.8, went down again to a new 38-year record low of 62.7%. So more people leaving the labor force, despite the good news, right? More people left the labor force. And in fact, the number of Americans, able-bodied Americans, who could be working, who are not in the labor force, now 92.6 million. This is a new record. I wonder how long it's going to take before that number hits 100 million Americans not working. So why is the labor force shrinking if the economy is so good? And if the economy is so good, why are average hourly earnings not rising? Now, the job numbers, yes, we are creating more than 200,000 jobs. But you have to understand why. And I think there are two dynamics at play. One, again, is the transformation of the workforce from full-time to part-time employment. As companies shed full-time workers and replace them with part-time workers, they generally need more part-time workers because they need to make up for the hours that have been lost. So you're going to have more part-time workers than full-time workers if you're going to go to a part-time workforce. Now, if you're an employee who has lost a full-time job, there's a pretty good chance that you may end up replacing it with two part-time jobs. So you used to have one job, now you have two. So all of these extra jobs count as jobs. The jobs report doesn't distinguish between full and part-time. If they create 200,000 jobs, it doesn't matter to the report whether they're full-time jobs or part-time jobs. But of course, it matters to the worker. It matters to the economy. But no one cares about that. They just look at the number. Now, the other dynamic that's going on that doesn't seem to get much attention either is the fact that at the end of last year, Congress did not extend the extended unemployment benefits. And so they lapsed. And so beginning at the end of last year and through this year, a lot of people have been exhausting their extended unemployment benefits, and there's been no reprieve. So they've actually lost their checks. And as a result, I believe that a lot of people are taking low-paying jobs that while they still had unemployment benefits, they refused to take. Because if you look at the component of the 248,000 jobs we created, not only this month, but all the jobs we've been creating so far in 2014, the vast majority of the jobs are low-paying jobs. Many are temporary jobs, many are part-time jobs. They're in the service sector, they're in hospitality, hotels, leisure, retail trade. These are the types of jobs that maybe people who were receiving unemployment benefits refused to take. See, maybe they lost a good job, a high-paying job, and they didn't want to take one of these low-paying jobs. They were holding out for something better, and of course, the ability to collect unemployment benefits made it easier to hold out for a better job because at least you were getting paid. And plus, there were probably some people who just wanted to take a taxpayer-financed vacation, and so they had no interest in a low-paying job. They would prefer to collect unemployment. But now the people don't have the choice. The unemployment gravy train is over for a lot of people, and so they have no choice. They have to take these low-paying jobs, and so that is one of the reasons that we are creating more jobs, because these jobs were going unfilled. They were going vacant because employers couldn't convince workers to take them because they had a better deal from the government. Now it's easier to convince people to take a job because they don't have the alternative of collecting an unemployment check. But this is not good news. This doesn't mean the economy is strong. And of course, there's a limit to how many more people are going to start taking these jobs. Eventually, you're going to exhaust the supply of people who were voluntarily absent from the workforce, and you're going to start to see far fewer jobs that are being created. But this also helps explains the dichotomy between what the statistics are saying and what the people are saying. Because I was watching this on, I think, CNBC this morning. There was one of the anchors was asking one of the pundits, to explain why there's this disconnect. Why do the people still think the economy is so bad when the numbers say that it's so good? And I don't even remember what the guy's answer was, but my answer is quite different. And it's because the economy's not good. It's the statistics that are wrong. If you had been hoping for a good paying job, but you're settling for a crappy, low paying job, are you really going to be happy about that? I don't think so. Just because you got a lousy job doesn't mean you feel good about yourself or the economy. Or if you've just thrown in the towel and you've left the labor force, are you going to feel good about your prospects or the economy? I don't think so. Or even if you have a job and you never lost your job, but you haven't got a raise, your wages are stagnating, but your cost of living is going up. Despite the fact that the Federal Reserve wants to pretend that there's no inflation, everybody knows that there is. I mean, average people feel it when they shop, when they try to spend their wages that aren't going up. So it makes perfect sense to me that the people don't feel the recovery, because in actuality, there's no recovery to feel. It's an illusion. And this is exactly what was happening before. I remember before the 2008 financial crisis, you had the same attitudes, the same disconnect. And it turns out that the people who were right, their gut was right, their instincts were right with respect to their own circumstances. And it was the pundits who had it wrong, because they had their head buried in statistics and they only saw the part of the statistics that they wanted. In fact, from my perspective, and I remember the giddy days of the housing bubble very well. I mean, most people seem to have forgotten that time period. Maybe it's very convenient that they've forgotten their collective, stupidity. But I remember pretty well. And I remember the attitude that most people had, particularly towards me, as trying to be the messenger, and having been shot so many times for trying to be the bearer of, what people looked at as bad news and trying to rain on the parade. But I remember how irrational everybody was when I tried to educate them about what was really going on in the economy and the housing market and the crisis that was in our future that nobody wanted to believe. But I believe that the collective irrational exuberance, the collective lack of understanding of the true nature and character of the U.S. economy and the financial markets is greater now, far greater than anything I experienced in that period of time. And far more frustrating personally to have to, witness it, knowing what I know, knowing what I believe is going to happen, and watching so many people foolishly jumping to the wrong conclusions. Of course, all of the euphoria with respect to this jobs number is all based on the Fed. And the idea that the QE worked, 0% interest rates worked, and because they worked so well, now the Fed can end it. The Fed can, take away quantitative easing, raise interest rates, and the recovery that was created based on that cheap money, based on 0% interest rates and QE, can continue without it. That the stock market and the real estate market that rose, right, on that sea of liquidity, right, can keep rising when you remove it. And of course, the idea that that can happen is so fanciful. It is amazing that otherwise intelligent people can fail to connect these dots to understand that if the Fed were to do what everybody is so convinced they're going to do, based on a lower unemployment rate or these jobs that are being created, if they were to do it, the jobs would disappear just as quickly as the QE. Because once they start raising interest rates, right, if they can even hold out that long, I think, again, the bubble can burst simply by ending QE. that it will burst before they get around to the first rate hike. But even if they manage to hike rates, a little bit, the markets cannot sustain it. The stock market can't sustain it. The housing market can't sustain it. Corporate America can't afford the higher rates. The banks can't afford it. Home buyers can't afford it. The federal government can't afford it. The fact is, they can't end these programs because they worked. They can't end them because they didn't work, and they will never work. Right? That's why I've always said QE is like putting out a fire with gasoline. This fire did not go out from the latest round of gasoline. It's just burning hotter than ever. A lot of people just don't notice it because often you have to remove some of the QE before you experience the pain. But all of the problems that people think quantitative easing and 0% interest rates solved, they just exacerbated. The problems are bigger than ever, which is why we're going to need an even bigger dose of QE to numb the pain as the prior dose wears off. So all the traders, everybody buying up dollars and selling gold because they're so convinced that the Fed is about to tighten and that none of the other central banks are, right? That Europe and Japan, they're going to keep doing more QE. The reason that Europe and Japan are still pursuing these cheap money policies is because they haven't worked there either. And the fact of the matter is, it's not that they didn't work in Europe and Japan, they didn't work in America. People just haven't figured that out yet because they're looking at the wrong numbers and they're focusing on asset prices and not the underlying economy. But that's exactly what you need to do. And again, that's exactly what I'm going to do in greater detail in my weekly podcast. So don't forget to check that out as well. So bye for now.